Hey everyone, I'm Steven.
And this is Joe.
We're both members of the portfolio management team here at SBSB, and we're going to talk to you guys a little bit about the basics of investing. Now, this is a really important topic because I'm sure as much as you guys love going to school and working all the time, there may come a day where you want to stop going to school and working all the time, and investing can really help make that possible.
Yeah, so we're going to open up with some trivia today. What do you think is the highest performing stock over the last 50 years? When you ask most people this question, you might hear answers like Amazon or Apple, and those are definitely companies that have done exceptionally well over the last 20 to 25 years. But if you look back over the last 50 years, the highest performing stock is actually from Altria. Altria is a cigarette manufacturer, mostly known for their main brand Marlboro. And $1,000 invested in Altria in 1960 today would be worth over $8 million. So to start off with some bad news, we're actually, unfortunately, not going to be covering how to turn $1,000 into $8 million by investing in the tobacco industry. But we are going to be covering a lot of the most important topics in investing. So I'll hand it over to Steven to get started.
So, why are we talking about this? Why should we be investing our money? Well, it's a natural progression. When we start investing our money, it starts making money for us. Eventually, in theory, it'll make so much money for us that we don't have to work if we don't want to, and we can start doing the things we want to do with our lives, while also taking care of all the long-term goals and obligations that we're inevitably going to have to pay for.
Right, so now that we've established why you might want to invest your money, the next question is, what do you invest in? And today we're going to be focusing on the two main players, which are stocks and bonds. So first up, with stocks, when you invest in stocks, you become a partial owner of a company. So for example, right now, there are about 700 million shares of Google. If you buy one share of Google, then you own 1/700 millionth of the company. And if Google does well and it grows over time, then your share should increase in value. For bonds, when you invest in bonds, you're basically lending money to a company or to a government. And over time, they'll pay you interest on that loan, and eventually you'll get your money back. With bonds, there's a more limited upside, because if the company does better than expected, you don't get to share in those profits. You're only entitled to those fixed interest payments. But there's also less risk in owning bonds. For instance, in the case of bankruptcy, when a company has to sell all of its assets, bondholders are going to get paid first. Whereas with stockholders, it's pretty rare that they're going to recover any of their investment.
So Joe's point about risk is really important because if we're going to talk about putting our money into any particular investment, we're going to have to think about the risks that are associated with it. Because unfortunately, all investments come with some varying degree of risk, and a general rule of thumb is the more return we're looking for, the more risk we're going to have to take. And put differently, the more upside potential we're seeking out of our money, the more downside potential we're going to have to be willing to expose ourselves to. So if we look at the historical performance between U.S. small stocks, U.S. large stocks, U.S. government bonds, and U.S. Treasury bills, another type of bond investment, we'll see that small stocks outperform everything else, and Treasury bills are the lowest performer. Now, when we think about the risk associated with all of these investments, we can see that, for example, the highest performing asset, small stocks, is all over the place over time, and what we're seeing is a lot of uncertainty about the true value of that investment, whereas with the lower returning Treasury bills, there's a general consensus that, yes, that's what that was worth at any given time. There's no variability among investors. And over the long run, and using the United States as an example, we'll see that stocks have, on average, returned about 10% every year since 1926, compared to bonds, 5%. So I know what you long-term investors are thinking here. 10's higher than 5. Why do we need to be talking about bonds? Maybe when we're all a little older, we can get into the bond conversation. But unfortunately, we go back to our conversation about risk. The more upside potential we want, the more downside potential we're going to have to be willing to expose ourselves to. And there are going to be times in your life where you can't afford to lose the money in question because of some short-term cash obligation that you may have. For example, or actually around this time last year, I was driving my car home from work when it completely died on me. Now, I was able to get the car to the mechanics and get everything fixed up, but the mechanic did let me know that my car didn't have much longer to live. And when he got a little more specific, he told me, well, anywhere from 0 to 12 months. So reluctantly, I set aside a few $1,000s for the inevitable down payment on a new car. But I didn't know if I was going to need this money 2 weeks from now or 11 months from now, and I didn't want my money to sit there not earning anything while I tried to pull all the life I could out of my old car. So, knowing that I needed at least $5,000 sometime within the next year, where do I put the money? Well, if we look at those same investments we were thinking about a little earlier, small stocks, large stocks, government bonds, and treasury bills, and we run an analysis of all the possible performances over the 1-year period given historical evidence, we get a better picture of where I might want to put it. A natural instinct is to want to put it into the small stocks. That was the highest performing investment of the 4 given. And if I put my money there, my $5,000 could be over $10,000 in 12 months' time. But unfortunately, it could also be closer to $2,000 in the same time period, which isn't going to cut it for me because I need at least $5,000. The same thing happens when I run an analysis on large stocks and government bonds. But as I move my way down the line to treasury bills, it turns out there hasn't been a 12-month period since 1926 where treasury bills lost money. Now, obviously, past performance is no guarantee of future results, but given historical evidence, I liked my odds in treasury bills, and that is actually where I ended up putting the money.
Yeah, so now that we've gone over a little bit about the pros and cons of stocks versus bonds, the next question is, how do I decide what to invest in? And the good news is you can have both. You can have a mixture. So, for example, right now my portfolio has about 95% in stocks and 5% in bonds because I'm aggressive and I don't need the money anytime soon. In comparison, my boss, Jeff Porter, has about half of his portfolio in stocks and half in bonds because Jeff is conservative and he's also still a little bit scared about what happened in the stock market during the 2001 recession. So if we think about a number of different portfolios ranging from a 100% bond portfolio all the way to a 100% stock portfolio, what you'd see is whenever you add stocks to your portfolio, the expected return is going to go up. But you're also going to have the negative consequence of greater short-term fluctuations, as what Stephen was talking about. So the range of potential outcomes will increase. When you're investing, the most important decision you have to make is deciding how much to invest in stocks and how much to invest in bonds. The academic research shows that it's not nearly as important to determine which specific stocks to invest in or which bonds to invest in. So, for instance, if you're thinking about investing in Ford versus General Motors, that question's not nearly as important as how much do I have in stocks and how much I have in bonds. Now, unfortunately, we can't tell you what to do because it really comes down to personal preference and your goals, but you're going to need to balance that higher expected return from more stocks with the greater fluctuations that accompany it. What I will say, though, is if you listeners are young, if you have a long time horizon, you don't need the money anytime soon, you're probably safe to have a good portion of your portfolio in stocks. Think 60% or more. All right, so now that we've discussed a little bit about investing in stocks versus bonds, we're going to dig a little bit into how to invest in stocks and bonds. And of course, the main way that most people are pretty familiar with is buying from individual companies. So like my example from earlier, this would be buying shares of Google. Now, when you invest in an individual company like this, it's pretty risky, and I actually have a quick story from a few years ago about how I learned this firsthand. It was January 2015 at the time, and I was in college, and I didn't know really anything about investing, but I had a friend named Tom, and Tom was showing me all the money that he was making buying and selling stocks, and he was encouraging me to open up an account to get started myself. And at the time, I was uncertain because it seemed pretty hard. I didn't really know what I was doing, but Tom was pretty successful, and then I remembered that he had a C- in accounting, so it couldn't be that hard, and I decided to give it a shot. I made the early mistake of going to CNBC for my investment research, and when I was watching, one of their talking heads came on, and He was talking about a company called Micron Technologies. Micron is a semiconductor company. They make chips that go into smartphones, so many of your phones are probably powered by Micron semiconductors. And I don't remember this guy's name, but he was highly respected in the industry. He managed hundreds of millions of dollars, and he got up there on the air and he went, "Micron Technologies is a strong buy. This stock only has one way to go, and that is up." So if you fast forward 6 months, you guys probably see where this is going. Well, Micron did only have one way to go, but that way was down. And 6 months later, I finally sold, and Micron was worth $15 per share at the time. I initially bought in at $30 per share, so I lost half of my money. I learned some valuable lessons from this, and I suppose it was a good time to do so, since being a poor college student, losing half of my investment meant that I just lost $40, so it was no big deal. The first thing I learned from this experience was that even if you've got a Ivy League educated, 150 IQ Wall Street analyst, doesn't mean they always know what's going to happen, and a lot of the times they're wrong. The second lesson was just on the riskiness of individual stocks. What I experienced was completely normal. There's nothing out of the ordinary from a certain stock losing half its value in 6 months. It just happens all the time. So with that said, given the inherent riskiness of investing in an individual company, what we would recommend is for you all to invest in a fund instead. So what is a fund? Think of it like a basket of stocks or bonds, where when you put in your money, your investment dollars are spread across a wide variety of companies. The first example of fund that we're going to go into is a passive index fund or ETF. These are great options for anybody. When you invest in an indexed fund or ETF, you're going to be tracking an index. What is an index, you might be wondering? One example you've probably heard of is the S&P 500, which is a collection of the 500 largest publicly traded companies in the United States. When you invest in an S&P 500 index fund, you're going to get the return that matches those companies. All of the return information we've been talking about so far, that's historical data from index funds. So historically in the US, investors in these funds have earned about 10% per year. So the second option would be to go with an actively managed mutual fund. This is an option for someone that's willing to put in more time and more effort to try and earn a higher return. With these actively managed funds, essentially what you're doing is handing over your money to a professional team that's going to invest it on your behalf. They're going to try and pick the best stocks and bonds to invest in to earn the highest return. Now, I will warn you with these funds that historically they've struggled for two reasons. The first is that the markets are just so competitive. It's so hard to outdo your competitors and pick the best stocks or bonds to invest in. It's very hard to identify those companies ahead of time. And then the second reason is these guys don't work for free. You have to pay a management fee that's sometimes pretty significant. The third option of a different fund that you could invest in is a target date fund. And these are great options for anybody, but especially those people that don't really want to spend the time thinking about it or worrying about it. So if you're listening to this and you're thinking, man, this stuff really sucks, I don't want to do this, I would rather be at the dentist right now than listening to this, target date funds are a great option for you. These are typically used in saving for retirement, and how they work is you need to pick the fund that corresponds to your expected date of retirement. So if you're thinking that you might work until the year 2060, you can invest in a Target 2060 fund. That fund is going to start out more aggressive in the early years, investing more in stocks to get that growth. As you near the target date, it's going to shift more into a bond-heavy allocation. And the reason for that is when you retire and you're drawing down on your portfolio, you never want to be forced to sell stocks when they're down 30 to 40%, as they sometimes are. So you want to have enough bonds in the portfolio to fund those withdrawal needs. All right, so now we're going to talk a little bit about the eighth wonder of the world, as it's sometimes called compound interest. So what is compound interest? When you invest in stocks and bonds, you're going to be getting dividends and interest payments, which typically you'll have reinvested back into the stocks and bonds. So you're getting paid, and that money is going to help you get more shares, which will earn you more growth, more dividends, more interest. You see where this is going. Basically, the money you make is going to make money, and that money is going to make money. Because of compound interest in investing, it's not linear growth, it's actually exponential growth, an exponential curve. So the lesson here is the longer you leave your money invested, the more potential there is for growth. We'll go over a quick example with some numbers to help quantify this. Let's say you're thinking about retiring at age 65, and you're going to invest $1, just $1, see where it gets you. If you invest $1 at age 20 into a diversified portfolio of stocks and bonds and earn the average historical return of that portfolio of about 7% per year, by the time you turn 65 and go to retire, that $1 will have grown to a little over $18. So you've made 18 times your initial investment. What if you wait until you're 50 years old and you invest $1 when you're 50? Well, by the time you go to retire at age 65, it may only be worth $2 to $2.50. So one way to think about this is the investor that started at age 20 had their money in for 3 times as long, but they made well over 3 times as much money as the guy that started when he was 50. So let's do a quick hypothetical scenario to help demonstrate this point. Starting with me, I start investing when I'm 20 years old because I heard about the phenomenon of compound interest and I wanted to have the time to benefit as much as possible. After I graduated college, I decided to keep living that frugal college lifestyle, so I had some extra money to put away, and I put away $3,000 per year from age 20 to age 30. Everything changed, though, when I turned 30. So on my 30th birthday, early that morning, I went out and I bought a house. It was a nice place out in the suburbs. Big yard, 5,000 square feet, and of course it came with a big ticket mortgage that I have to pay for every month. Later that afternoon, I was at the hospital, and my wife gave birth to triplets, 3 extra mouths to feed. And, well, raising kids isn't cheap, so that was a big hit on the wallet. To top it all off, that evening, I got a call from my lazy, good-for-nothing brother, who called to tell me that he lost his job and that he was moving into my basement. So just like that, with that triple whammy, suddenly I had no more money to invest. I just had that $30,000 invested, and my money earns a 7% return.
Now let's say I took a different path. I didn't make a lot of money when I was younger, and let's just say for creative reasons, my employer and I decided to part ways, and things got so bad at one point I was forced to move in with my brother, his wife, and his 3 screaming triplets, with the only saving grace being all the square footage we were living in the suburbs. Now, it took some doing, but by the time I was 40, I had my act together well enough to start investing. I didn't have any short-term cash needs, so I had a general goal of trying to retire by age 65. I knew I had some catching up to do, so I'd contribute $6,000 every year for the next 25 years until I turned 65. And using my brother's good advice, I ended up getting 7% on my money.
Yeah, so just to summarize all that, I have $30,000 invested that I put in my 20s. Stephen had $150,000 invested that he put in from age 40 to 65. So with that said, and given that we both earned the same return, who do you think has more money when we go to retire at age 65? Well, turns out I do. I have $470,000 compared to Stephen at about $400,000. And this is just due to that phenomenon of compound interest. Getting your money invested earlier, it has so much more time and potential for growth.
So we know that investing is important, and we know investing early is important. But before we start that, we need to ask ourselves a couple questions. First, am I going to need this money in the next 6 to 8 years? So kind of like my car example, are there any short-term cash obligations that are going to mess with the overall allocation to my portfolio? Am I currently carrying any credit card debt? Now, interest payments on late fees for credit cards are really high, but generally we're saying here, make sure you can pay your bills before you start investing. This may come as a surprise, but investing without keeping the lights on can be counterproductive. And the third, more philosophical question of the 3 is, who am I as an investor? How comfortable am I with market risk? And that answer is going to be different for everybody. and it's going to be hard to quantify at the beginning, but a simple way of thinking about that is how much of my overall portfolio am I willing to lose for the sake of potential return? Now, that'll be different for everybody, but let's say, for example, we can't stomach more than a 25% loss in our overall portfolio. So even though my investor profile may say I could have 90, 100% stocks allocated to my portfolio, if I'm not comfortable with that, I'll just scale it back to maybe 70% stocks, and I'll fill that remaining allocation with 30% of safer bonds. And I can do that through a total stock market or a total bond market index or mutual fund like Joe was talking about earlier.
So hopefully by now you guys are getting very excited, you're eager to put your money away, but you might be wondering where to start. I mean, how do I buy a stock anyways? Do I go to the bank? The answer is no, you don't go to the damn bank. What you need is a brokerage account. And there's a lot of options out there. We'll highlight 3 of them very quickly. So first up, 2 that we like are Charles Schwab and Fidelity. These are both what you could call full-service brokerage accounts where you can buy and sell almost any investment, and you have access to professional research at no cost. So these are great options for anybody. If you're looking for something a bit simpler, one route you could go is Acorns. Acorns is a mobile platform where you just need to decide whether you're conservative, balanced, aggressive, very aggressive. Once you choose your category, they'll build the investment portfolio for you, so you don't need to worry about it. And another cool feature of Acorns is if you link it to your credit or debit card, then whenever you make a purchase, it will take the change to round you up to the next dollar and invest that at no cost. So effortless savings for many people. But in summary, what brokerage account you choose, it's not nearly as important as simply getting started early with investing.
Before we sign off, we want to leave you guys with some final pieces of advice. First and foremost, make sure you're ready. All we really mean there is make sure you're paying your bills and that you understand the investment tools that are available to you. Try to ignore short-term market forecasts and predictions. The younger generations know better than anybody how quickly daily headlines can fall out of relevance, so try to keep a longer-term view on your portfolio outside of any short-term cash needs that you may have. Historically, we've found that long-term forecasts and predictions are more accurate than short-term. Avoid making emotional decisions when investing. Now, I can say with a pretty fair degree of certainty that sometime throughout your investing career, it's going to feel like the world is ending. All of your investments are going to be losing value, and you're going to feel like you should sell everything and head for the bomb shelter. But before you do that, remember that volatility is normal. Embrace that volatility and trust the investing process. And finally, keep it simple and stick to your strategy. Simple is going to mean 10 different things to 10 different people, but generally what we're saying here is understand where you've put your money and then stick to the strategy that you've put in place. If you've taken all the right steps, you can rest easy knowing that you've totally got this.
And that's all from us. Thank you guys so much for listening. If you have time, please feel free to check out the other presentations. So we've got one on budgeting, one on credit, one on tax, all of your favorite topics. They're all out there. We'll see you next time. This is Joe signing off.
And I'm Steven. Thank you, everybody.